Hello everyone, welcome to the PwC Tax Bite podcast series. My name is as always Pieter Dree and I'm happy to invite in my virtual recording studio today Jonathan de Ramet, Gilles Francis and Evie Geerts.
Hello.
Jonathan is not a tax expert, but he's here because he's assisting large enterprises in their fit for growth trajectory and manages large end-to-end transformation projects. I invited Jonathan today to talk about business transformation, something that comes up in many discussions that we have with businesses, and I thought it would be good to dive a little bit into some of the key topics in that discussion. And for that, I invited Gilles and Evie. Evie will enlighten us a bit on the international tax consequences and aspects, where Gilles will focus more on the transfer pricing aspect. So, very welcome in my recording studio. Well, I just suggest that we kick it off. In many discussions, we have been talking on business transformation, but perhaps it's good, Jonathan, if you can enlighten us a bit on the broader context from your perspective on this.
All right, thanks, Peter, and happy to be here. What we've seen the last year is that there have been many macroeconomic shocks coming to different companies. So a couple of years ago, we had COVID that we're still lingering with. We had the supply chain disruptions that came out of it. Inflation, energy, ESG is high on the agenda. There are new technologies, so things are speeding up. And so this is leading many companies to rethink how they are working, what they need to produce, etc. It's very transformative for them. And so I think today there's three areas that we'd like to focus on things that really have major impacts on how organizations are working. One of them is digital transformation. So the way that companies are interacting with customers, the way that they have their people do their work is changing dramatically through digital. It's giving new channels, it's giving new ways of working that are leading to efficiency, but also to different ways of interacting. There's also the entire element of products that are evolving, becoming more digital, companies that are moving more to services around products or even completely to other services enabled by digital. So there's a huge space there. I think the second topic, which is very impactful, is the entire war for talent. Finding the right people. The entire move of workforces that are retiring out of companies, making it more difficult to find new talent in that same location. So the need for flexible hire where talent is, etc. So this entire space of how are we going to staff our work in a different way with a different mindset is a second big area companies need to look at. And then three is the entire supply chain problematic. We know that the supply chain has been under a huge strain for COVID, for the geopolitical problems that we had over the past months and years. So there's a huge redrawing of how we have to do supply chain, how we can move things more locally, how we manage the risk around global versus local. So this is the third big area where we see companies really looking to completely rethink how they operate.
Thanks, Jonathan, for giving us that context. You nicely slice it up in three topics: digital transformation, war for talent, and changes in supply chain. So I suggest that we look at them one by one, and perhaps Gilles to start, looking at the tax aspects of digital transformation. What's your perspective to that?
Yeah, so for digital transformation, as I think Jonathan, you introduced it quite well. There's quite a few dimensions to it. So there's the way in which you go to market, but there's also the way in which products are becoming more digital, essentially. And for me, from looking at it from a tax angle, there's two key elements which all of these have in common, which is one, that there's a big change in the value chain, which could impact the taxable nexus and profit allocation. And then secondly, there's a potential recharacterization of payments, incomes compared to the traditional business models which companies may have. And maybe I'll just give an example on each of those from working with clients in going through these type of transformations. So maybe starting off with the first topic, which I mentioned around changes in value chain, changes in taxable nexus, maybe using e-commerce as an example here. So within e-commerce, you may not have the same margins as you would have in your traditional sales. That could be because you try to enter a new market segment. For example, you try to target smaller customers. And that means, of course, that if the business you're operating is of a lower margin across the sort of system, you can't leave the same level of profit for the local sales and marketing entities, which, assuming that these are involved at all. And, that brings us to the nexus element as well, because from a nexus element, the local entity may not be involved at all in this e-commerce sales process. You might be billing and organizing everything centrally. And that then gives opportunities from an efficiency and simplicity perspective on how you design the model. Of course, to the extent that there's still local activities happening, there is a need to consider on how to remunerate this, because that might be, as I mentioned, different to how your core model works. On the second topic on characterization of the payment and the income, so say we have a new digital product instead of a physical one, that means that the sale may be characterized as a license, which could result in withholding taxes on intra-group or customer transactions. Having a different type of products which you're developing might also mean that you can use different tax incentives, which might all of a sudden become available to you. For example, if you create a virtual product, you might be able to leverage patent boxes, which you might not have been able to use in your sort of traditional business. Of course, the characterization element is also relevant beyond the product dimension, and also the business model such as e-commerce could come into play in terms of the characterization question. But I don't know, Avi, if you have anything to add on that from a sort of broader international tax perspective.
Yeah, absolutely, Gilles. 2 points. The incentive piece you mentioned is an interesting one, because indeed, as you say, many jurisdictions have some kind of tax incentive linked to the creation of software or digital activities. But often some kind of nexus is required to that jurisdiction to be able to benefit from those incentives. So in your overall tax strategy, it will be important to assess if and whether you can make or want to make use of those incentives. We all know that under Pillar 2, the type of incentives you use have an impact on your Pillar 2 calculation. And that will undoubtedly bring quite a bit of a shift in the overall incentives that are available, as many tax authorities and governments are thinking through the incentives with a Pillar 2 lens, so to say. So that's the first one to really keep an eye on, those incentives. How do they influence your decision and what will happen in the future? And then the second one is, and I'll keep that short, on withholding taxes. It is a hot topic throughout Europe and abroad. So make sure you understand the differences, whether there is a withholding tax piece linked to your payment, the formalities you would need to fulfill, even if there is no withholding tax due, because the last thing you want is that you're caught by a 30% or more withholding tax payment on your revenue streams, which will give you a completely different model. And then lastly, let's not forget about the digital services taxes, but we will need to see what happens with Pillar 1 before we can give a conclusive answer. So that, Gilles, as a roundup on some of the international tax topics to think about, incentives and withholding taxes being the most important one.
Yeah, clearly digital transformation is an important aspect of the debate. The second point was the war on talent, which is also quite often heard, I think, in various questions. So Evie, perhaps you can continue and enlighten us also a bit on the international tax aspects of the war for talent.
Sure, happy to, Peter. Because it is indeed something we are confronted with on a daily basis, whether it's part of a large project or a small one-off question. But the war for talent has influenced multinationals to really use all their bargaining chips in hiring people, whether it is attracting talent abroad, offering them the opportunity to work for long stretches from abroad. Just think about the many hybrid and remote job opportunities you see today in the market. Again, while this is a welcome tool for HR and recruitment teams, it is important to make the link to your tax strategy, as there are a number of important tax implications to take into account if you just start hiring people across the board or where you can find the talent, so across borders. The most important one and the one we are confronted with on a daily basis is obviously permanent establishment, or PE. Can be triggered quite easily. One person abroad could be sufficient to trigger a permanent establishment, depending on his or her functions and what they do. But then obviously on top of that, you have personal tax and social security liabilities and profit allocation, not to forget, because one person abroad might not overturn your total transfer pricing model. But if you have pockets of people abroad, that might be a different conclusion. But we'll talk about that with Jill in a minute. And then, as I said before, once you start moving people and you, for example, rely on incentives, tax incentives in your model, you also need to consider what the impact is there. A common example we are confronted with often is obviously your centralized group that has a large number of people, decision makers, and important people functions centralized in one jurisdiction, and that are, for various reasons, struggling in maintaining their workforce, hiring people in that same jurisdiction, or even confronted with situations where people ask to work from abroad or from their second home for long stretches of time. That can create a home office PE, either a material one or a place of management PE, and can lead to questions around profit allocation. From a personal tax perspective and social security perspective, obviously you have a timing to take into account, but from a corporate income tax perspective, there's no fixed timing linked to the creation of a PE. So it is very important to upfront set a clear strategy together with the HR team on this. There are many things you can do. A lot is possible without any major negative corporate income tax consequences, but you want to set that strategy upfront rather than being confronted with it afterwards. So, Jill, maybe handing it over to you. We have discussed cases in the past where solutions like regional hubs, branch models, employment companies are being considered, but the million-dollar question remains, what is the tipping point before I have to alter my transfer pricing model?
Yeah, and I think the most common way, I guess, organizations deal with having this dispersed workforce, if you will, looking at it from a transfer pricing angle, is by allocating some sort of service fee, routine return for the services provided by the sort of dispersed workforce. And usually that return takes the form of sort of a markup on the costs of the individual. Of course, and you sort of alluded to it already, Avi, it starts getting more challenging when key decision makers within the organization are moving outside the location of the central profit owning entity. And one decision maker moving typically won't shift the dial too much, as their personal bargaining power is linked to their salary. So it's more difficult to argue that in an intra-group context, then that bargaining power of the employing entity of that individual, if you will, is much higher all of a sudden. Now, of course, if you get to having a critical mass of those decision makers, or a critical mass of people outside your central profit owning entity, now that might require you to change the local returns of where these people are located. And that could be, for example, having a commission instead of a cost-based return, having a sort of kicker on your cost remuneration. Could even go into the direction of sharing into a pocket of the profits. And in those situations, it becomes very, very critical for companies to have a government structure in place upfront before these moves of people start happening, on how to start measuring that critical mass and make sure that some guardrails are set in place, basically to avoid unintended consequences on the transfer pricing model, and at least be very deliberate on basically knowing what it means if the organization needs to hire from elsewhere.
Okay. Thanks, Jill. Yeah, war for talent, clearly very important topic. I think the third one that we touched on, and we still have time, I think, to also look a bit into the consequences of that, is changes in the supply chain. So, Jill, perhaps you can continue and also enlighten us a bit on that.
Yeah, sure. And what's interesting about supply chain is that you can see some different forces at play here. So looking at it from a European point of view, you know, have the high energy prices, which, you know, will be familiar to everyone. And those are sort of re-energizing in certain industries, the plans for offshoring, for example. On the other hand, you also have the trend of deglobalization, if you will, you know, bringing certain production capacities back into Europe to safeguard supply. Particularly noticeable also in critical industries, such as, for example, chip manufacturing. If you look at some of the decisions of major companies recently in investments into Europe, but also, you know, big investments into the US from elsewhere. And, you know, this is, of course, a fundamental overhaul into the operating model, which has, you know, quite a few dimensions in terms of the tax impact. So, for example, if you look at the move from moving European manufacturing or production capacity offshore outside Europe, some of the elements which you might, you know, that will come at play are, for example, exit taxes if you move production capacity. There's of course also the proposed European carbon border adjustment mechanism, which would put a levy on the import of carbon-intensive products in certain sectors. So if those are produced elsewhere with a heavier carbon footprint, there might be an additional levy when you bring those products back into Europe. And then also an important one is that not all countries outside Europe allow for a simple lift and shift of the tax model, which the group might be used to in Europe. For example, in Asia, certain structures such as working with variable royalties, which target a local return, those might not be possible at all, whereas the group might be used to having some of those in Europe. If you look at then the other dimension, so where production volumes are brought into Europe, again, here there's the tax incentive angle, so that could take the form of subsidies or tax incentive. And then also, yeah, you would have to see how the investment frames within the broader strategy of the group, and to see how strategic is the new investment, and what is the profit potential that is linked to it, and by extension the profit that needs to be left into the European operations. And then, you know, the big elephant in the room when we talk supply chain, there's of course a big indirect tax and customs impact when there's changes in supply flows. All of these, I think, are angles which are fairly fundamental to be taken into account into the business case when thinking through some of these big transformational changes. But perhaps, Evie, you can also add some of your thoughts on this one.
Absolutely, Jill. The one thing I would add is that one shouldn't underestimate the impact of Pillar 2. I think these items, the exit taxation, the CBAM, and the green taxation that is coming, the incentives that both the US and Europe are foreseeing in that field will definitely play a role. But what is maybe less on the forefront, if you think about making your decision, is that global minimum tax impact. Obviously, shifting assets and shifting people will have an impact on your substance-based carve-out, because that is based on capex and employment cost. So that could impact your potential top-up taxation. But also the complexity of accounting for PEs under the Pillar 2 rules, the impact of qualifying and non-qualifying tax incentives, and the asset transfers pre and post implementations of the rules will have an overall impact on the tax cost that is actually associated with your new supply chain model. So again, maybe not something you would think about immediately when we say supply chain transformation, but another reason as a tax team to stay close to the business and make sure that you are involved in those discussions as from the beginning, because there are many relevant factors to take into account. And again, items that can come with a significant additional tax cost.
Well, thanks, Evie and Gilles. So we touched on some of the key aspects, I think, of the topic of today, the digital transformation, the war on talent, the supply chain. And I think you very comprehensively touched on some key tax aspects of that. We're just wondering, actually, now, Jonathan, you as a non-tax expert being here in this podcast and hearing all of these points, I just wonder, I'm curious, what are you taking from this?
Yeah, I'm always amazed on as a non-tax person, so always in the business talking to BU leads, VPs, etc. Tax is typically the last thing on our mind when we look at those transformations. Yet, what you hear today and what we often see is that it's actually very strongly intertwined with the work that you want to do from a business point of view, and can actually have a lot of impact on the ultimate value you can generate. And so what Evie was saying, I think, is absolutely true. I think tax needs to be brought in from the very start when we are drawing up these type of transformations, when we're building the plan, just to make sure that all of these aspects are taken into account, because there's a huge pocket of value you can win or lose based on the choice you make there. So for me, that's kind of the key takeaway. It's business and tax going hand in hand, driving these type of transformations from day one.
Well, I couldn't have said it better, Jonathan. Hand in hand, very, very right, very well put. With that, I suppose we can close this podcast. I thank the audience for tuning in, but of course also my speakers are very, very thanked for being here and sharing their views and thoughts. Stay tuned on this podcast, and we'll make sure that all the relevant topics will be on the agenda in the next episodes. Thank you.